Yeah, morning, guys. Sort of European earnings have been a little bit more mixed. I mean, it's still early days. Our hunch is that the impression that earnings season will leave after it's finished is one of continued steady improvement for the European corporate sector. We have been seeing for a while now a long anticipated pickup in profitability in the European corporate sector. That's a function of the economy continuing to grow above capacity, chewing into that above potential, chewing into that excess capacity. We think that continues, but there's no doubt that there are still some things to worry about with regards to Europe.
And let's talk about that then, with specific regard, William, to the banks and Deutsche Bank, just out with their second quarter numbers. Christian Suing says that they are heading in the right direction in terms of cost management, etc. But the broader problem, as I see it, is revenue has declined faster than costs. When do you think they're going to finally start turning that around?
Yeah, I mean, it's difficult to say for Deutsche, certainly, but I think, in a sense, it's a nice encapsulation of the wider, some of the problems that the wider banking sector faces. The European banking sector, one of the reasons why we're interested in it right now is because it's it's still not in a great state. There's, in Europe in general, the sector is overbanked. You're not going to get a very helpful central bank for some time to come. You've got still steepling non-performing loans, all of those kind of things. But the thing for us really is that this represents an opportunity, that generally you are seeing a gradual improvement in the backdrop for the banking sector. Unemployment is down. You're finding demand for credit is picking up. Those non-performing loans are going in the right direction. And the sort of regulation and the backdrop for the sector is now suggesting that you may start to see some within border consolidation. These things are all positive for shareholders, potentially. But let's face it, this is an area within our asset allocation where we are cautioning sort of our clients that it's a so-called hairy trade. This is a risky area to get into, but one we think that there's significant upside potential for those who have sufficient risk appetite.
And turning to the auto sector, what do you think earnings in that patch are going to look like, William? Because my sense is that they'll probably be holding up pretty well on headline, but it's the forward guidance and how cautious they are going to be in the future that could be concerning for the markets, considering Washington may very well soon activate those tariffs on car imports.
Well, this is a good point, because really it's not about what's happening now, it's what might happen in the future, as you rightly say. And the auto sector, if you look at kind of one of the difficulties of prosecuting a nice clean trade war in the modern economy, it's almost impossible because supply chains globally have just exploded and reorganized along sort of cost lines. And the auto sector is the prime, probably the foremost example of that. Supply chains have simply exploded over the last few decades and reorganized along very different lines to what they previously were. And that means that tariffs on intermediate goods, which you've seen already, are already starting to hurt profit margins. And this is not a sector with big fat profit margins generally. So it is one that is, should be a worry in the context of that trade war. And it doesn't really matter where it's based, to be honest. US, Europe, Asia, they will all probably find life a bit tougher in this new kind of trade environment.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.